Being first-time founder, you're on a mission to create something great. You register a company, you are building a product, and then you want to learn how to be compliant with the law and how to not to overpay taxes and not to miss something. So we're going to discuss one of the most brilliant tools created for founders, and this is 83B election. Of course, you heard a lot of this and you are wondering why you should do this, why it's just 30 days limit. So we're gonna discuss it in a lightning fast way and explain it to you like to a 5-year-old, so you can explain to your 5-year-olds. And here today with me, Tigran Haratunyan, the United States tax advisor, who's gonna explain and show you examples, and then you probably would be able to have questions to us, so you can go on our comments, leave us thumbs up and subscribe to our channel. So then it would be appreciation and support for us. Tigran, hi.
Daniel, thank you for having me. Yeah, today we're going to discuss 83B election. Probably every startup founder has heard that from their lawyers, whoever forms their company. And many people just make the election not quite understanding what that means. Well, this is one of the most fascinating game theory problems embedded in the US tax law. And today we're going to find out what that is, try to explain it to a 5-year-old, and see how you can make the election and whether you need to make that election. So 83B election explained to a 5-year-old. So 83B election allows for recognizing income from restricted stock at the time the stock is granted. Now, if after hearing this, your face looks like that, I don't blame you. My face looks like that too when I heard this first. However, today, let's try to explain this to a 5-year-old. So let's say we tell a 5-year-old kid, we'll put 5 boxes with candies on the table, which are closed. You don't know how many candies there are in each box. Now you're allowed to open 1 box a day. There's one condition. When you open the box, you must share it with your friends. You must give half of the candies in each box to your friend. So let's say the girl says yes. She starts opening the boxes. On day 1, she opens the first box and there are 100 candies in it. On day 2, there are 50 candies, then 150, 120, 180. Total of 600 candies in 5 boxes. Now, as agreed, she must give half of that to her friends. So she must give 300 candies to her friends. This is great. But what if the kid is actually greedy and wants to keep more candies? Now, how can she apply the principles of 83B election to actually keep more candies? So let's say she tells her friends, how about I give you candies today before we even start opening the boxes? And we'll assume there are 100 candies in each box, total of 500 candies, and we get 250 candies today before we even open the boxes. Now, no one knows how many candies will there be in the box. So the friends are like, 250 candies isn't that bad, so we'll take that. So they get 250 candies, and whatever is in the box will be the girls. Now, you don't have to be a genius to understand that at this point, if there happens to be less than 500 candies after opening the boxes, the girl has made the wrong decision. So the friends will actually keep more than half of the candies, right? However, if there are more than 500 candies in the box, then the girl has made the right decision. So she'll actually keep more than half of the candies. Now, let's try to see how this principle can be applied in an adult world. Let's replace the child with an adult, Candice with stocks of a company, and friends with the government. Now, before we dive in, let's understand 3 very important principles that every founder should be familiar with: restricted stock, granting, and vesting. So let's say you hire an employee, or you want to be an employee of your own company, and you agree that part of the compensation will be giving some shares of the company to either one of the founders or an employee you hire. Now, the problem here is, what if the employee or the founder takes the stock and quits the company then on day 2? Now, this won't be beneficial for anyone. Therefore, corporate lawyers have come up with the notion of restricted stock. It basically company after they've been with the company for a period of time. Now, when the agreement is made to grant restricted stock, that's called granting. When the stock becomes available, that's called vesting, after that person has stayed with the company for a while. Let's look at the example. So let's say 500 shares of certain company with $1 par value are granted to an employee on this day in 2023, with vesting of 100 shares scheduled on the same day every year until all 500 shares are vested in 2028. What does this mean? Today, the employee is granted 500 units of restricted stock. Now, how many stocks is this employee allowed to sell today? 0. How many stocks is this employee allowed to use as a collateral to borrow money? 0. If the employee quits the job or the founder leaves the company, 0 shares will be left with the founder. Now, after exactly 1 year, 100 shares will vest, which means at that point, exactly 1 year, the employee will be able to either sell 100 shares or use it as a collateral to get a loan, or even if the employee quits the company. So that becomes property of the employee. After 2 years, 200 shares. After 3 years, 300 shares. Up until 5 years, when all 500 shares are vested, at that point, they're the property of the employee. And regardless, the employee stays with the company or not. Now, obviously, the stock price doesn't stay the same. Let's say in 2024, the stock price actually stayed the same. It stayed $1 par value, and with 100 shares, $100 vested. In 2025, the price of a stock went to 50 cents par value, and now, I'm sorry, fair market value, and now you received $50. Then 150 in 2026, 120 in 2027, 180 in 2028. So in total, you received $600 worth of shares. Now, by default, because you physically become the owner of the shares when they vest, it is recognized an income by the government. So in 2024, let's just assume for the simplicity that tax rate is 50% and there's only one tax. So in 2024, because you received $100 worth of shares of the company and they vested, you will pay $50 in tax. Next year, 25, then 75, then 60, then 90. So you'll pay $300 total in tax. Now, this is by default. However, and that's a lot of money. However, what if you remember the 83B election from your childhood? Well, since 500 shares were granted today, you're allowed to tell IRS that you will recognize the revenue from 500 granted shares today at the par value. So if today, in 2023, you're granted 500 shares and the par value is $1, you can make an election to pay income tax of $500. And again, we'll assume it's 50% and there's only one tax. You'll pay $250 in tax. However, in the future, when the shares vest, you will not owe any tax on them, any income tax on them, regardless of their fair market value. Now, generally speaking, you must make a very thorough consideration when making this election, because if the stocks of the company go down, you'll actually end up losing money. You'll end up paying more tax if you make that payment. But everything changes for startup founders, because startups usually have a very tiny stock value. I mean, some Delaware C Corps have a par value of $0.00001 per stock, which means if you own $10 million of shares or $10 million of restricted shares, it's still only $100. So at most, you end up paying $50 now. But let's say in 5 years, the stock price goes up to $100. And at that point, you actually are worth $1 billion. And if you did not make the 83B election, you will actually owe tax from $1 billion, not from $100. And this is when 83B makes a crucial, a vital difference. Now, let's go and talk about a couple of details. Right now, you have to make that election within 30 days of granting. So if the shares of the stocks are granted on March 15, you must make an election before April 14. If you don't make that, you will default on that, right? It will go default to just 83A, which basically means that you will owe tax when the shares vest. Now, there's no template of this form, so you can't just go on IRS's website and download the form and fill that out. So you must basically come up with your own form. You must put your full name, address, social security number. If you don't have a social security number, just write foreign, the description of the stock. You must also say that you're making the 83B election, and you must also provide that you have provided a copy of that document to the company. Then you must sign and mail it to IRS. Now, the address you're mailing to depends on where you are physically located. So you will go to IRS's website and type in the search box, mail 83B election, and it will show you where to mail it based on your physical location. Now, let's look at a sample 83B election form. Now, this is not a legal advice. You must talk to a lawyer. You must talk to a professional before making this election, right? But this is how a form could look like, right? So Willie Coyote from any street in any town in any state with social security number, such and such, makes 83B election in regards to 100 units of restricted stock of Acme Co. granted on December 1st, 2023 at a par value of $1 for the year 2023. Signature date, you must also write that a copy of the election was provided to the company with which the agreement was made. So there we go. 83B election. This is the end of the presentation, and I'm happy to answer to any questions.
Awesome. So thank you so much, Tigran. What about signing extra documents? Like, do you need to sign vesting agreement with the company before you do 83B election? And when 83B election period of 30 days starts, when you incorporate a company or when you sign vesting or a contract with the company under vesting?
If there are no vesting terms, 83B election will not make any sense, right? So if you're just given stock in a company today, you will pretty much have to pay income tax on the value of the stock you received today, well, for the year you received it, and that's all, right? You're done, right? So 83B election will not make any difference for you, right? So therefore, there have to be a vesting agreement, not a legal advice, but most vesting agreements must be written and must be signed by both parties. Yes, there have to be a vesting agreement, right? And the vesting agreement will generally say when the stock is granted, right? So today, you are granted 500 shares that will be vesting within 5 years. Now, you can do it on the day you founded the company. You can do it later, right? It's up to you, right? Most corporate lawyers will do your vesting agreement or your shareholders agreement alongside with forming the company, right? However, you have to go by the shareholder agreement and by the day the stock was granted to you, right? So if it was, you founded the company on February 10 and you signed the shareholder agreement on February 25th, 30 days will count from February 25th. So it's always from the day of granting.
Okay, so not to worry for everyone. If you incorporated but you didn't sign the vesting agreement with the company, so your vesting period and 83B election hasn't started. So this 30 days will start once you have this agreement in place. Now, we have a lot of foreign founders that are outside the United States as well, are asking like, do we need 83B election or not? In some situations they don't, in some they do. Can you elaborate on when they need it and when they don't?
Right. So this is for people, right? So 83B election gives you more favorable treatment when filing your personal U.S. taxes, right? Now, if you are not planning on moving to the United States, if you're not planning on filing US tax returns, if you're not planning on having US income, you generally will not benefit from 83B election, right? 83B election will benefit you if you are going to have US-based income. Now, why most lawyers, right, most corporate lawyers will generally advise, and also most of the accountants, right, will advise you to make the election, because you never know, right? In the beginning of a startup, right, again, the total value of shares is barely $100, right? So the most you will pay is $50. Okay, you lose that money, you lose $50, right? But in the future, if you come to the United States, if you have income connected with the United States, that you end up actually having to report income from those shares on your personal tax return, you better have the 83B election so you don't have to pay huge amounts of tax. So that's why many founders will actually, well, many founders will make that election even if at that very point they're not US residents.
And a final question. If an employee joined a company, worked over 1 year, so they don't have a cliff, and you probably want to say what cliffs means, and they left a company, do they automatically get granted the stocks, and or they need to pay after being, I don't know, fired, or maybe they left themselves the company? So do they need to do anything?
Well, it will depend on the agreement, right? I mean, a standard agreement will be employees granted certain number of stocks, right? And the employee must work with the company certain amount of time, right? And if employee quits or employee is fired, generally they will default on the vesting agreement, and they will only keep the shares they had that had already vested by that time. Now, having that said, and not a legal advice, but generally it is not forbidden to have a vesting agreement that will more specifically say in which cases of employee termination they will default on the agreement, right? So, for example, if the employee is fired, in that case, they will not lose vesting, but if the employee leaves the company themselves, they will lose that, right? So it really depends on what your agreement says, right? Generally, there are no limitations. Government doesn't really interfere on how you decide that kind of stuff within your company.
Sounds fantastic. So, guys, if you have any more questions, please go in the comments below and ask all the questions. Tigran and myself, we will try to assist you as fast as possible and give you all possible right variants, what you're looking for. So we want to help. Please spread this video among your network, on other social media and startup groups. We want to help you guys so you have the right knowledge of doing the right thing. And Tigran will be giving you more advice in the comments. So press the like button, and of course subscribe to the channel. And if you want to have specific videos like this on other things such as vesting, what is vesting, how to apply it for yourself, for your employees, what scenarios, if you want something like that, or maybe something else, let us know, and we will make sure that you get a quality explanation that you can explain to 5 years old. Take care of yourself. Thank you, Tigran, and let's stay in touch. See you soon.